Outsized opportunities pass us day by day as we're told the lie that the market is efficient. But the truth is, we are humans, and humans make mistakes, and Adobe is the biggest mistake humans have made in a while. Yeah, possible. All you need to know is that Adobe is priced for negative growth, so we're going to investigate to see whether it deserves this rating of negative growth by using 4 different tools. And if I think it's trading below intrinsic value, then I'll allocate 15% of my portfolio to the company. So the only question we have to answer is it reasonable that Adobe can keep cash flow flat? Margin of safety is a great tool to make money on market inefficiencies, but it's just not enough here. I want to bet money that I'm going to make money on this investment, which is why it's such a valuable indicator when we see these videos come out. This is the first of our 4 tools that we're going to be using to see if the stock is trading below intrinsic value. And no, these aren't bottom indicators. Stop saying they're bottom indicators. And it's the same guy on every video. Must be getting desperate. But they are sentiment indicators. Each one of these channels have massive influence, crushing the sentiment of the perceived value of the business that it's the subject of, uniting a mass of angry customers to make the problem at hand feel a lot larger than it really is. This is what I call a sentiment margin of safety. I'm sure it's already a developed idea, but for our purposes, this is how I perceive it. The market gets angry about a certain industry and business, not realizing the real value that it's bringing in pursuit of the individual creator to have outsized reward from humans' innate desire to see bad press. And once those rewards are reaped and people once again to think freely on the subject, the value of the business is still standing and it's realized, and possible alpha can be found. Well, in theory, of course. Now, this does not work on all business sectors, cycles, and whatnot. It works when you directionally predict the performance of the business, which should change sentiment. The sentiment margin of safety is not a strategy, but rather an observation about psychology, and this is especially helpful to use in conjunction with a margin of safety to better identify bottoms. Okay, I guess I kind of proved myself wrong, but still, you can't predict where the market's going to go. But if the business is able to perform well, then sentiment should become positive. For the rest of the video, we'll provide methodology which supports the full conclusion of Adobe. Now, to avoid this coming off as investment advice or a surefire way to make money, please understand that depth of analysis never means guaranteed returns. Take everything I say with a grain of salt, no matter how severe the language. Check all facts. Everything I say is opinion. I can tell you exactly why right now you should not invest in Adobe. Adobe operates in an industry where it is extremely hard to predict the landscape in 10 to 20 years. Thus, the terminal value is hard to value. Let us take the recently released Bank of America report, which is our second tool, and suggests a trading price of $190. Aliani was the leading analyst on this report and has a 56% success rate and is a 5-star analyst. So clearly in this investment, there is good opposition. They cite a growth rate of 10.5% in 2025 to decrease to 8.8% in 2027. But a strong idea that they're citing is that there's really no near-term catalysts that are going to allow for acceleration of Adobe growth. They cite that mainly that we're going to be losing to things such as casual users not needing the full Adobe. Seems like something that could really materialize. Additionally, the report cites a free cash flow margin of 39%, which seems rational in the face of freemium, possibly compressing margins. But the report only gives us assumptions for the years 2026 to 2027. Then in 2028, they provide us a free cash flow margin, but we get nothing except a multiple that can be used to find the terminal value, and we get the multiple of 7x in 2027 cash flow. So we get 2 years of growth, and then for the way I model, we get terminal years that span from 2028 into infinity, which suggests negative 2% growth rate. If we do the valuation from the standpoint of owner earnings, which I believe are the most rational in the face of share-based compensation. But I feel like this is not the correct way to go about it, in my opinion. I feel we should have slowly declining growth from the growth years into the terminal years. And this gives us an implied growth rate of negative 3.46% terminal, if we're sitting at where the stock is trading at as of the making of this video. Additionally, the truth is the market does not like freemium. It's seen as a risk to the market that has no guaranteed payoff, since there's real possibility here that you never deepen your relationship. And initiatives such as Firefly potentially cannibalizing the stock image sector, which seems to be happening in real time according to the management. And what's next? Photoshop and other Adobe products? But here's a question. We understand the idea that creatives like to have full control in supporting the idea in their head to be displayed on the creative canvas. So I feel the change from stock to AI to almost make sense in this context. Creatives see AI as a way to support the creation of the exact image they have internally into a real digital portrayal. But what about Photoshop? Well, Photoshop does the same thing where you're supporting the exact image that you have in your mind and then it's portrayed on the canvas. I don't see this as something that AI is going to be able to replicate, because personally I feel like it makes sense in the context of stock photos, but I don't see how you could replicate the same vision of the creator in the world of Photoshop. But because we are in the beginning days of AI, we have to understand. We don't know how creativity will be impacted by AI or incumbents in the space that Adobe operates in. But I can tell you that the market is quite sure that Adobe will not be the top choice in the next decade or two. As I see the fall of Adobe stock to be sourced from the re-rating of the terminal value of the company. For our purposes, that's the years from 10 years out all the way into infinity years out. But does it not seem irrational to bet so heavily against a company that's so heavily ingrained in American corporate culture? Of course, you can argue that corporate is not the entire base of Adobe, but the truth is much of it actually is. But not only this, but the enterprise side, meaning other businesses and professionals, continue to integrate further and further. At first, I wanted to use document cloud growth from 2019 to 2022 to show Adobe's dominance in growing revenue here. But then you realize that this is the time of COVID and this is when everything went online, so document cloud became a much more necessary item. So this growth was more about what happened during COVID and not from Adobe's own strength. But then I stumbled across this. 40% of the top 50 enterprises doubled their ARR, which means their top clients doubled their spend with Adobe, so top clients are getting more integrated rather than less so, like the market predicts into the future. Might I remind you that all Adobe has to do is keep cash flows flat for it to be trading above intrinsic value. You don't often get growth like this in the past and a valuation like this. And you know what? I think I have further evidence that Adobe has real structure in place to keep cash flow flat. If we come back to this metric, we see that .cloud growth is no longer individually recorded, but if we look to the segment that it is reported in with business professionals and consumers, we see that this segment is growing at double digits, meaning that it's very likely these balances are being at least retained, if not growing. Many companies have changed how they work because of how valuable it was for employees to work at home and online. Thus, the growth of .cloud has been at least retained, it appears. Now we're coming up to the exact reason why I bought Adobe in the first place. Remember I said the main reason for the fall of Adobe shares is a re-rating of the terminal value of the company? When we discount the cash flows that Adobe may or may not make 20 years into the future, we realize that we would pay a lot less for those cash flows than those that are 20 years out from now. Which is why I see this figure as such a strong signal, because the first 3 years of the valuation make up such a large percentage of the intrinsic value of the company, meaning that the growth that we have in the next few years will be extremely important in the valuation of the company. But still, if companies move away from using Adobe, then it's likely trading above intrinsic value, and we will lose money. So we have to make a rational case that is directionally correct for why people are not going to leave Adobe. First off, for the current initiatives that we've taken materializing, we see Digital Experience, the part of the company that is focused on marketing technology, has a specific line that's outperforming AEP and Gen Studio. AEP, while introduced in 2019, seems custom tailored to the AI age. So I guess AI being the main emphasis of society has a consequence of AEP growing like this recently. But why is AEP so strong for AI? Because in the past, when you were sourcing data on specific assets and projects within your company, these would be spread out between different projects. But now you have a whole holistic view on all the performance metrics of the specific project or asset. And using AI with all of this data is a huge plus for the marketers. As AI becomes more integrated with AEP, it continues to benefit. This seems like a fair correlation to derive from the numbers. Furthermore, Gen Studio allows for enhancement of a business's campaigns, as they're able to generate a range of digital assets with a common theme, meaning that they're able to cut down on the hours of creation simply by just generating with Gen Studio. Now, like any good non-monopolist market, Adobe has some good competition in the realm of data and analytics. Salesforce and Oracle, to name a few specific ones, but Adobe is different because you have the software in which the campaigns are actually being created on, meaning that you have one whole integrated system by using Adobe. The value in this integration seems extreme in my opinion, and this is exactly what the data is suggesting is happening. Currently, the growth in cross-cloud deals are widening, growing at 60% year over year. The truth is that there's a lot of people who are not buying just for the data or the software anymore, but rather for the integration of both these options, and this is becoming a more popular offering. Seeing growth in a metric like this shows that the client values data, which is going to be more important in the age of AI rather than less important, and Adobe will have this data seamlessly integrated into their platform. To me, the idea works perfectly here. But what about future initiatives? Because if Adobe cannot keep up in the realm of future games that we played in AI and creation, then you could say goodbye to your money as Adobe slowly seeps away into nothingness. We all know about Firefly, but through Firefly, Adobe is making Firefly Foundry. This will allow companies to be fully integrating their IP brand style and other product assets, meaning that the AI will be custom tailored to their style of creation. Yes, you could spend hours trying to generate illegal images with Midjourney, or you could generate the exact brand ideas that you've been building on for years. And yes, I understand that this is an unproven future initiative, that this is speculation of whether this would could actually be adopted into the market. But is that not what the market is doing to Adobe, with the idea that they're going to become subpar in the coming years? Yet the very existence of Firefly Foundry, Gen Studio, and just Firefly in general is evidence that Adobe is at least taking the right steps to protect themselves from that in the future, which means that the market is playing favorites by finding other companies' future efforts to build valid while they treat Adobe's as null. Okay, and yes, there are a lot more competitors than there are Adobe's, but does Adobe's market positioning not matter at all? I argue that it does, and they will be able to introduce stronger AI options than competition and introduce them to corporations and generate value here. We've talked about digital experience, which is for marketers and includes AEP, AEM, Gen Studio, Marketo, campaign, and analytics, and we understand the value that digital experience will bring in the age of AI. But the question becomes, how resistant is the whole business? Because 75% of the business is still this creative platform that could end up getting replaced. So the question I want to ask is, why do people buy Creative Cloud? Why do they buy the editing software, the creation software from Adobe? And they do it, as I believe, for a few reasons. First off, those who already use it have high implicit costs to generate elsewhere in the near term. When someone starts creating Adobe, they agree their skills are worth the price tag of the original amount in which they're paying, so they can economically cover subscription fees. And as they continue to work, their integration within the software grows deeper, meaning what they are paying for becomes more and more valuable to them. And so to go develop somewhere else costs tremendous efficiency that could end up being hundreds or thousands of dollars a month for an individual creator, and for a whole business, maybe millions a month to translate their whole team off an instrument they've become terribly familiar with. But a natural argument against this idea is if these new instruments have efficiency built into them, then clients could extract value further along than the implicit costs that make up the switching cost. Maybe AI is able to cut out team members that you would be paying a salary to otherwise, and then all of a sudden it becomes a lot more attractive. But efficiency does not guarantee quality. If you think about the products being produced with Adobe, it's marketing campaigns, content, movies, photography, illustration, websites, digital experiences, 3D content that's often used in video games, and audio. These products encapsulate a lot of what Adobe is used to create, and I feel they naturally sit in three categories: entertainment, art, and marketing. For marketing, we've already touched on data and why I think this shall be retained, but in the world of creating the marketing campaigns, I believe that this will remain human-centric until AI proves it is better. And I just don't think that's happening yet. And in my opinion, it's not something that's going to happen for a while. If we take a look at these studies, we find that AI appears to roughly match human effort in raw CTR when controlled, but human ads had more conversions than that of AI ads. In the world of marketing, just a few points of conversion for a big corporation can mean millions of dollars. So having those points means that it makes sense to keep their current advertising efforts. Efficiency does not mean quality, and quality that brings conversion is the most important aspect in marketing. Maybe brand awareness, but I would argue that this is in pursuit of future conversions, which to me is essentially the same idea. Let us consider what makes a good marketing campaign or ad in general. I would say novelty and resonance, something unique that's going to catch the attention in the eye of the public, something that stands out. Ideation matters the most in the creation of good ads, and because LLMs pull from what's already been done by humans is extremely difficult, if not impossible with them. Not until they can start making their own ideas, I guess, but who knows if that's coming soon. No, but really, if AI is able to become sentient, then that could be a real threat to the thesis overall, so it's something to consider, I would say. Truly, I feel that means if human ideation is essential to the highest conversions, then the use of human creation too is essential. Until we can unlock AI being able to perfectly replicate human ideas, tools such as Adobe will continue to be essential in the creation of the human vision in its fullest form. Marketing, I feel, has better prospects than the market is telling us. Second off, let us consider art. What really makes art popular? How cool it looks, how long it takes to make, whether an elephant painted it or not. No, none of these things. Well, actually, the elephant thing was pretty popular. No, but what really makes it popular is the human thought and idea and portrayal of events that we all understand as humans, the mystery and novelty of it. I'd argue chess is an art. Each game is a display of art. I've been a long-time enjoyer of chess, and I've watched games that have entirely put me on the edge of my seat, and humans suck at chess compared to robots, yet I've never watched a robot play chess. There's no value in my mind, no mystery. And illustration is even more art than chess is, as art is a subjective form. While chess, you can quantify good and bad moves. You can understand whether a game is played perfectly. Chess has been solved with 7 pieces, but there's no solving art. So once again, what is important in the world of art? Human ideation, once again. Finally, we have entertainment. This is where it's more of a split decision, in my opinion. If you think about higher quality content like a movie, you go to watch for the ingenuity of the director or the performance aspects, and I feel we've already quantified that as a risk. As long as this is the case, I see Adobe as a necessary tool. But if we consider regular content, the barriers barriers to entry are lower, the expectations are lower. So truly in the world of entertainment, I see this as a split issue. What we find entertaining varies very much so, and it's a subjective idea. But I feel in most issues, we see Adobe relies on humans being the main driver of value in the world of creation. And even if this is not the case in 10 years, the company has hedges against this. And I feel that this can only be uprooted in the case of a transition of AI being the main driver in the world of creation. And I just don't see this happening in the near term. But the problem is that terminal value. We just don't know the market that Adobe is going to be playing in 10 years from now. So there's no way to wiggle our way into a position. Right? Yet when we look into the model, we see that the first 10 years of the company make up 52.2% of the valuation of the company. And we see that the intrinsic value of the company sits at around 307-ish with our current assumptions. So what if we just multiply the weighting of the first 10 years by the total intrinsic value of the company to find what the company can rationally trade at? By doing this, we're not saying that the terminal years are foggy, but rather that the terminal years are certain to not exist in the case of Adobe. And by doing this, we see that the intrinsic value of the company sits at $161 per share. I see this as beyond the worst possible case scenario and is the exact reason why I decided to buy the stock in this video here. I believe this scenario to be the worst in the world for Adobe, and when I bought originally, the stock was trading close to this price. So with this, I've decided that it does make sense to make an investment here. If you want to take a look at the original video that convicted me to make my investment decision, it's linked right here. But wait, make sure to sub first. I'll have videos like this coming to the future.